What if I told you that right now, as you're watching this video, gold is knocking on the door of $5,300 an ounce? Not 5,000, not 5,100, but 5,300, while silver has just posted its 10th consecutive monthly gain in a row. Think about that for a second and understand that this is no longer just a trend, but a statement. And if you're not paying attention to what's happening in the precious metals market right now, you might be watching one of the most significant wealth transfers of the modern era pass you by completely. Welcome back to Silver Signals. I'm your host, Yali Jiang. And if you're new here, genuinely welcome, because this is the place where we break down what's really happening in the gold and silver markets and what it means for your financial future. If you've been with us for a while, you already know we focus on analysis, context, and real talk rather than hype. Today, that real talk centers on what happened on February 27th, 2026, when gold surged nearly 2%, silver closed above $94, and oil jumped more than 3%, all on the same day, which is not a coincidence, but a signal you need to understand. Before we dive deeper, I want you to subscribe and turn on notifications because these markets are moving fast and updates matter more than ever. What happened on February 27th is one of those market days that people will reference for years to come. By the end of this video, you are going to clearly understand what this coordinated move in gold, silver, and oil actually means and what you should be thinking about next. To understand why February 27th was such a landmark session, you need to zoom out and look at the broader environment we have been living in for months. Gold and silver have been climbing steadily, with silver now marking 10 consecutive monthly gains that signal something structural rather than speculative. When a market produces that kind of streak, it tells you that consistent capital flows are moving underneath the surface and building pressure in a way that technical breakouts alone cannot explain. On February 27th, that underlying pressure collided with geopolitics in a very visible way, as tensions between the United States and Iran escalated sharply. The USS Gerald R. Ford arrived in Israeli waters alongside the USS Abraham Lincoln, creating a rare dual-carrier presence in the same region at the same time. Add to that the reported deployment of nearly 20 aerial refueling tankers positioned in Israel, and markets quickly interpreted this as the infrastructure for a potential military operation being put into place. A dual-carrier deployment is not routine military theater, but a high-level demonstration of force that serious observers immediately recognize. When such assets move simultaneously with rising diplomatic friction, investors understand that the probability of escalation has materially increased. Markets do not wait for headlines to confirm outcomes. They price risk the moment credible signals appear. Many people simplify the story by saying gold rises when the world feels scary, but the reality is much more complex and far more important for investors. When gold, silver, and oil all surge together on the same news, it signals that the market sees systemic risk rather than a localized event. Oil rising on U.S. Iran tension makes sense because supply routes, such as the Strait of Hormuz, carry about 20% of the world's oil, so any disruption threat immediately affects pricing expectations. However, gold and silver rising alongside oil reveals something deeper about investor psychology and capital allocation. It suggests that participants are hedging not just energy supply risk, but broader concerns about inflation, currency stability, and the resilience of the global monetary system. When capital rotates into hard assets across the board, it reflects a collective move toward tangible value in the face of uncertainty. Adding more context, U.S. President Trump publicly expressed dissatisfaction with the progress of Iran nuclear negotiations, while evacuation advisories were issued by the United States, Canada, and India for citizens in Iran. Governments do not issue evacuation guidance lightly, and such decisions communicate that risk assessments have shifted meaningfully behind the scenes. Iran's response promised a devastating reply to aggression, even as negotiations were scheduled to continue in Vienna on March the 2nd, reinforcing the sense that diplomacy and military leverage were unfolding simultaneously. When talks and troop movements happen at the same time, markets interpret that as high-stakes negotiation with asymmetric risk. The carriers are real, the tankers are real, and the diplomatic meetings are real, which means the path forward can change rapidly in either direction. That uncertainty is precisely the kind of environment that drives capital into gold, because gold does not need to predict outcomes, it only needs elevated stakes. Now, I want to pause and ask you directly where you stand in this precious metals cycle. Are you already holding physical gold or silver? Are you invested in mining equities? Or are you still watching from the sidelines, trying to time an entry? Or perhaps you are skeptical and wondering whether this rally is different from the ones you have seen before, because your position and mindset matter in how you interpret everything unfolding right now. Looking back at the raw numbers from February 27th, the scale of the moves deserves serious attention. Gold closed at $5,280 per ounce, rising nearly 2% in a single session, which equates to over $100 of movement in one day. Silver climbed over 6% to just under $94, extending a 10-month winning streak and signaling momentum that goes beyond a short-term headline reaction. A 6% single-day gain in silver on top of sustained monthly advances tells you that this metal is not simply shadowing gold. Silver is exhibiting leadership characteristics driven by both monetary and industrial demand forces converging simultaneously. When you see that kind of performance layered on an already strong structural backdrop, you're looking at more than noise. Silver's unique dual role is central to understanding this cycle because it functions both as a monetary metal and as a critical industrial input. The expansion of solar panel manufacturing, electric vehicles, and advanced semiconductor production has structurally increased silver consumption year after year. As trillions of dollars flow into clean energy and technology infrastructure globally, the mining industry has struggled to expand supply at the same pace as demand growth. This creates a powerful double-engine dynamic where safe haven flows and industrial demand reinforce each other rather than compete. On February 27th, the geopolitical engine accelerated sharply while the industrial engine was already running at high speed beneath the surface. When both drivers push in the same direction, the price response can be dramatic and sustained rather than fleeting. For those who have been in precious metals for years, skepticism is understandable because previous rallies have faded after tensions cooled. You have seen gold spike on geopolitical headlines and then retrace once calm returned, and you have watched silver surge only to surrender gains later. The key difference this time appears to be the convergence of geopolitical risk, elevated global debt, accommodative monetary history, and structural industrial demand, all aligning simultaneously. In earlier cycles, one primary catalyst often dominated the narrative, whether it was currency debasement, political instability, or commodity demand. In early 2026, multiple powerful forces are operating together, creating reinforcement rather than isolation. That convergence is what gives this move the characteristics of a structural bull phase entering a more intense stage rather than a temporary spike. When you consider gold at $5,280 and feel like you may have missed the opportunity, it is important to frame that number historically. Inflation-adjusted comparisons to the 1980 peak suggest that alternative measurement methodologies place prior highs at levels that still leave room for debate about current valuation. In other words, credible arguments exist that even at these prices, gold may not be historically overvalued relative to decades of monetary expansion. Silver becomes even more interesting when viewed through the gold-to-silver ratio lens that long-term investors track closely. With gold at $5,280 and silver at $94, the ratio remains above 55, which sits within but not below long-term historical norms. If that ratio were to compress toward 45 while gold holds steady or advances, the implied silver price would move meaningfully higher without requiring extreme assumptions. These are not predictions, but frameworks serious investors use to evaluate relative value in potential scenarios. When multiple valuation perspectives suggest room for further movement, it reinforces the argument that this cycle may still have runway. Structural bull markets often feel expensive at every stage until hindsight reframes them as foundational repricings of value. We are living through a period where gold nearing $5,300 reflects a global reassessment of safety, trust, and tangible assets. Silver's 10-month winning streak reflects both industrial transformation and renewed monetary recognition converging in real time. Oil rising alongside them underscores how interconnected commodity markets transmit geopolitical signals directly into pricing structures. So where does that leave you in practical terms as you evaluate your own position? If you already hold physical metals, the structural drivers discussed today are not the kind that disappear overnight with a single headline. If you are on the sidelines, the anxiety about timing is natural, but the broader framework suggests this may be part of a longer structural move rather than a short-lived speculative bubble. If you remain skeptical, that skepticism can be healthy, provided it is grounded in data rather than discomfort with rapidly rising prices. Examine the convergence of geopolitical tension, monetary conditions, debt levels, and industrial demand growth before drawing conclusions. Markets send signals, and February 27th delivered one of the clearest signals in recent memory. Gold, silver, and oil moving together was not random, but a coordinated reflection of rising systemic risk and structural demand. Silver Signals exists to help you interpret those moments with clarity rather than emotion. Today's signal was powerful, and understanding it may shape how you navigate what comes next. If this analysis provided value, take a moment to like the video because that small action helps this content reach others who need to hear it. Subscribe and turn on notifications so you stay informed as this market continues to evolve rapidly. I'm Yali Jiang. This is Silver Signals, and I will see you in the next one. So stay sharp, stay informed, and keep watching the signals.